Picture this. You're holding a contract that guarantees you $99 billion in future revenue. I mean, it's the exact kind of backlog that most tech companies would literally kill for, right? But here's the catch. To actually build the massive physical infrastructure required to cash that ticket, you have to take on $35 billion in highly leveraged debt today. That is the explosive core tension sitting right at the heart of CoreWeave. Today, we're unpacking a company that is perfectly positioned as the critical bottleneck for the entire artificial intelligence revolution, yet at the exact same time, it's fighting against a balance sheet that could completely suffocate it before it ever reaches sustained profitability. So let's just dive straight into this absolutely staggering number. As of the first quarter of fiscal year 2026, CoreWeave is sitting on a contracted revenue backlog of $99.4 billion. And look, this isn't some theoretical pie-in-the-sky demand or optimistic forecasting. This is real money, driven by massive, multi-year take-or-pay commitments from the absolute titans of AI. We're talking OpenAI alone accounting for up to $22.4 billion of that. And Meta? They just expanded their commitment to $21 billion all the way through 2032. It's wild. This gives CoreWeave a level of extreme utility-like revenue visibility that we have rarely, if ever, seen in the history of the tech sector. But you knew there was a but, right? Here comes the intense visual whiplash. You can't just run a trillion-parameter AI model on a promise. To physically build out the literal gigawatts of data center capacity needed to service these massive contracts, CoreWeave has had to take on $35.15 billion in total debt and lease obligations. They're operating with a highly leveraged capital structure, leaning heavily on floating-rate debt instruments and just totally unprecedented capital expenditures so they can buy specialized chips and secure physical grid power. It is quite literally a race against time and interest rates. Okay, let's get into section 1, the NeoCloud economic engine. To really understand what this company is doing, you have to know that the global AI total addressable market is projected to hit $160 billion by 2027, and it's rapidly compounding from there. CoreWeave is attacking this as what we call a NeoCloud. Think of it as a highly specialized, bare metal GPU utility, purpose-built specifically for the AI era. They aren't selling general business software. They rent high-performance graphics processing units, massive storage, and low-latency networks directly to the Pioneer Labs training foundation models. But why are these cutting-edge AI labs choosing CoreWeave over the legacy cloud giants? Well, traditional hyperscalers run these massive systems designed for broad enterprise IT, using virtualization and hypervisor layers that actually slow down and degrade raw GPU performance. CoreWeave, they just rip all that out. They provide raw, bare metal hardware access tuned entirely for high-density compute, and they offer this immense power at an estimated 30 to 50% discount compared to generalized clouds. It's a real game changer. And this really illustrates exactly what they are up against. Just look at the massive scale of their traditional competitors. Amazon Web Services is sitting on a 29% market share, Microsoft Azure is at 20%, and Google Cloud is holding 13%. These giants have essentially limitless capital reserves and deep entrenched enterprise relationships. For CoreWeave to survive, let alone actually thrive in this space, their hyper-focused strategy on pure compute workloads isn't just some clever marketing angle. It is an absolute fundamental necessity to prevent themselves from being crushed by these massive incumbents. So what's the actual engine driving their survival? It really relies on 3 distinct pillars. First, they have a deep strategic partnership with Nvidia, who holds a 9% equity stake in CoreWeave. This is huge because it guarantees CoreWeave priority, early-stage allocations of scarce next-generation silicon, like the Blackwell and Vera Rubin architectures. Second, once a client trains a massive petabyte-scale model on CoreWeave's hardware, migrating that data out introduces absolutely massive egress fees and technical downtime. So the switching costs are sky-high, and they're locked in by contracts that average 4 to 5 years. Finally, power. Global data center capacity demand is rocketing toward 220 gigawatts by 2030. CoreWeave is using its massive financing to aggressively secure long-term physical power allocations in a U.S. power grid that is currently incredibly constrained. Which brings us to Section 2, the market's central conflict. Actually, quick side note before we look at the financials causing this conflict. If this kind of research-first analysis is your thing, you'll probably want to subscribe to these explainers. All right, back to it. If CoreWeave is locking down scarce power and securing billions in bulletproof contracts, why is there so much fear and volatility surrounding the stock? Well, the massive friction lies squarely between their aggressive capital expenditures and a looming debt crisis. Let's look at the hard evidence. On May 7th, 2026, CoreWeave reported their Q1 2026 earnings, and it perfectly captures this conflict. On the top line, things looked amazing. Revenue came in at a massive $2.078 billion. That's up 111.6% year over year, beating analyst consensus by 5.5%. But you've got to look at the bottom line. A staggering GAAP net loss of $740 million, drastically missing expectations. Why did they miss so hard? Because they took a $536 million hit on interest expenses alone and recognized $1.147 billion in depreciation on their deployed hardware. Right now, the sheer cost to fuel their growth is completely overwhelming the cash it generates. Now, management is fiercely defending this dynamic. CFO Nitin Agrawal came out and stated that their adjusted operating margin of just 1% in Q1 is the absolute trough. They argue there's a critical timing lag between when they deploy capital, literally paying upfront for hardware and colocation fees, and when they actually start billing their customers, which can be up to 3 months later. With active capacity now exceeding 1 gigawatt, management claims they are finally approaching what they call escape velocity, and they're projecting sequential margin expansion for the rest of the year. But as you can probably guess, the market isn't entirely convinced yet, largely because of this massive figure right here. During that very same earnings call, management raised their full-year 2026 capital expenditure guidance to an eye-watering range of $31 to $35 billion. This huge acceleration in hardware component pricing completely spooked the market. Combined with a very tight current ratio of 0.46, investors suddenly realized CoreWeave is going to remain heavily dependent on continuous debt issuance just to fund this expansion. And this dynamic is exactly what helped drive the stock price down to today's level of $73.21. Which brings us to a really crucial synthesis of their overall business quality. Based on the underlying research, CoreWeave scores a blended 5.7 out of 10 on our scorecard. And the contrast here is just extreme. On one hand, you have a phenomenal growth outlook at a 9 out of 10, completely locked in by that massive $99 billion backlog. But financial health? That is a terrifying 3 out of 10, purely due to the immense leverage weighing on their balance sheet. And honestly, perhaps the most concerning piece is management alignment, sitting at just a 4 out of 10. Listen to this. Over a recent 3-month period, executives, including the CEO, offloaded more than $3 billion in shares on the open market, with absolutely zero insider buying. When insiders take that many chips off the table during a highly capital-intensive expansion phase, it understandably signals intense caution for public investors. Now, I should mention that all of the research behind this explainer was created using Flash by StockSentinel.ai. You can generate deep research reports exactly like this one for literally any public company in the world, completely free at flash.stocksentinel.ai. The core company research is free. If you want an ongoing investing edge, Flash has a premium feature called Best Ideas Now. Every week, it surfaces the highest conviction ideas across 3 investor styles: long-term compounders, hidden gems, and dividend hunters. Portfolio Watch monitors your portfolio and flags important changes, and Insider IQ tracks meaningful insider buying activity worldwide. You'll see a QR code in the bottom right of this explainer. Scan it to download the Flash app and try it yourself, or just access Flash on the web at flash.stocksentinel.ai. Pricing is going up over time, but once you lock in your subscription, your price never increases. All right, let's jump into Section 3, our 5-year scenario framework out to 2031. Now, before we dive into this framework, I need to state this clearly. This is a hypothetical framework for thinking about possible outcomes. It is not a prediction, and it is not financial advice. The stock could go much higher or much lower than any of these scenarios. Let's walk through the math to see what actually drives this valuation from today's price of $73.21. So the base case, which implies a future price of $169.57 and an 18% annualized return, assumes a steady, disciplined conversion of their massive backlog. It essentially requires them to successfully scale their active power to their target of 8 gigawatts by 2030, eventually reaching a 10% GAAP net margin and trading at an 18 times exit multiple. But look down at the low case. If specialized neo-cloud rivals like Nebius, who actually operate their own proprietary data centers instead of leasing them, trigger a fierce price war, raw GPU compute could rapidly commoditize. If margins compress all the way down to just 4%, and the market slaps a hardware commodity multiple of 12 on the stock, the share price drops dramatically to just $21.75. Conversely, the high-case models a scenario where AI demand remains completely supply-constrained, margins expand to a highly profitable 15% as capital expenditures finally level off, and the stock commands a premium 25 multiple. That drives an implied price of $564.
And hey, if you want to access the full model with all the detailed assumptions for each of these scenarios, you can check out the detailed research report over at flash.stocksentinel.ai.
So, considering the absolutely vast spread between those scenarios, we have to stop and ask the most important question for any investor looking at this space. What actually breaks the thesis? What are the concrete, asymmetric threats that could structurally impair CoreWeave's highly leveraged business model? Well, these are the asymmetric risks that are keeping the bears awake at night. Number one is customer insourcing. Remember, CoreWeave lacks proprietary software intellectual property. They are essentially just renting out third-party hardware. If major anchor clients like Meta and Microsoft successfully transition standard inference workloads over to their own custom silicon, they will just bypass CoreWeave entirely. Second is hardware commoditization. Next-generation architectures are rapidly shortening useful GPU economic life cycles down to just 3 or 4 years. If older platforms depreciate faster than expected, CoreWeave faces massive asset impairment charges hitting their balance sheet. And finally, physical grid constraints. Regional grid operators, like PJM, are already warning that hyperscale expansions are severely straining their load forecasts. Regulatory moratoriums could literally freeze new facility deployments, leaving CoreWeave holding incredibly expensive, completely unmonetized data center leases. So let's pull all of this together with the 3 core takeaways you need to remember. First, CoreWeave is fundamentally a story of extreme contrasts. You have unprecedented revenue visibility backed by a $99 billion backlog, but it's standing face-to-face with an incredibly fragile capital-intensive balance sheet carrying over $35 billion in debt and leases. Second, the escape velocity margin timing. Management's claim that Q1's 1% margin is the bottom absolutely must be proven true. They have to demonstrate that the lag between massive capital deployment and actually billing customers will resolve into profitable cash flow. And third, the looming insourcing threat. The ultimate test of their long-term durability is whether they can retain pricing power as their very own biggest clients rapidly try to build custom chips. If you are watching this stock, here is exactly what you need to focus on next. Investors must aggressively monitor whether CoreWeave can successfully execute the physical deployment of Nvidia's liquid-cooled Vera Rubin systems without massive supply chain or grid delays, and crucially, whether they actually hit double-digit adjusted operating margins by Q4. If they execute, they prove the entire model works. But if they stumble, that massive mountain of debt could become totally suffocating. It leaves us with one final multi-billion-dollar question. Will CoreWeave's massive infrastructure gamble crown them as the ultimate utility of the AI revolution, or will their debt load suffocate them before they ever reach the finish line? If you want the full research, including the deeper framework behind this explainer, you can get it free at flash.stocksentinel.ai. Until next time, do your own research, and I'll see you in the next one.
Check out Flash at flash.stocksentinel.ai to access free research and videos like this one for any company in the world.